What does this mean to you in terms of the going forward, specifically for the dollar?
Hello, Nancy. Great to be here. Yeah, it's been a calamitous day, hasn't it? Certainly, we've seen the US dollar index now fall 15% over the past 12 months, and that trend certainly is intact now as well. With the global equity market falls, and not just what happened in the US overnight, but we've seen the European share markets now come off on 6 consecutive days as well. And if this trend continues, it looks like the fear will continue. And once that panic and volatility continues to increase, this trend could continue. And I think that's what the market is trying to ascertain at the moment, rather than trying to pick tops and bottoms in the market. But you know, we saw on Friday a really robust jobs report in the US. Average hourly earnings are quite strong at 2.9% annualised. They're talking inflationary expectations, and all this has transpired, Nancy, just as the new Fed chair, Jerome Powell, takes his seat. Replacing Janet Yellen. So it's quite interesting, the timing with the market expressing this fear now. But we've said all along that this is a buy the rumours, sell the facts scenario. The markets tend to play this way over time, and history repeats itself, and that's the main lesson to be learned from what we've seen in the last 24 hours.
Yes, Tony, we've been talking all day about quite a difficult setting, a backdrop, if you will, that Jerome Powell will see as he assumes a new post here. But overall, do you think there's anything in the fundamentals that will change the market's assumption of where the Fed goes from here?
Yeah, I think there is, Nancy, and I think it'll be really interesting to watch how he positions himself going forward, because the Fed's preferred measure of inflation, the PCE deflator, is around 1.5%. Yet the target of 2% is what they're anticipating will be achieved in 2018. Hence the reason why the market's expecting 3 Fed rate hikes this year. But given the global equity sell-off that we've seen, if this trend continues over the next few days or weeks, then we might see March come off the table, and we might only be talking about 2 rate rises rather than 3. And so the propensity is for the US dollar to remain weak whilst this indecision occurs. So I think that will certainly be the telling factor.
And Tony, what do you make of this breakdown really between the US dollar and US Treasury yields? Because once again overnight we saw the US 10-year yield in fact tick lower as the dollar was going higher. Is this at all an indication of some of the confusion out there in the market about these really extraordinary times when you talk about a massive fiscal stimulus underway, when you're really tightening the monetary stimulus strings?
Yes, that's right, indeed. And I think that's what the market is trying to understand, Nancy, is, you know, this expectation of 3% yields in the US market has been talked about for some time now. But the fear that investors have is what does that mean to the rest of the market, not just the share market? If we see slower demand for consumer items and a weakening, say, in new houses being purchased, and that sort of trickle-down effect, if you like, that will affect the stock market, then we're going to see the market remain rather cautious, and perhaps the Federal Reserve will also be doing the same thing and remain on hold. But what we've seen is, for example, in our local case with the Aussie dollar, we've seen a widening of interest rate differentials now, because the RBA today has left interest rates on hold for the 18th consecutive time, yet the market's expecting 2 or 3 more rate hikes in the US. And so a widening of interest rate differentials in favour of the US could see some of these commodity currencies also feel the pressure and head south in coming months.